effectively what we would be doing is we would look to either do a stock sale or an asset sale, because there are some tax advantages to doing an asset sale where you can get the kind of the step up in basis for the fixed assets, and then you get an incremental depreciation over the life of the deal. But then sometimes you're also creating deferred tax liabilities or deferred tax assets, which can be a little bit complicated from a modeling and kind of realization perspective.
So I'm curious, like in your experience, what would you find is the biggest frustration when it comes to exiting these highly appreciated, businesses? These M&A mergers and acquisitions are happening, and all this tax, right? What is your thought process when it comes through that, and or 1031 exchanges, or the different things that are associated with tax?
Well, I'd say in truth, I am not a tax professional, and so when I was heavy on the buy side and doing the PE work, we would often bring in a professional to really analyze the tax implications of the deal, because on the business side, I was more about the P&L and the balance sheet modeling, and then the tax pros as well as the legal team would kind of help us optimize the structure. But effectively what we would be doing is we would look to either do a stock sale or an asset sale, because there are some tax advantages to doing an asset sale where you can get the kind of the step up in basis for the fixed assets, and then you get an incremental depreciation over the life of the deal. But then sometimes you're also creating deferred tax liabilities or deferred tax assets, which can be a little bit complicated from a modeling and kind of realization perspective. But overall, what you're really trying to do is just optimize the company so that it is tax efficient on exit. And this is going a little bit beyond my expertise, but a lot of the entities that we would set up would be tax efficient in such a way that at least the LPs came out with the most tax efficient strategy. And that was sort of vary based on where the company was located or based on the structure of the deal. So I wish I was a little bit more of an expert on that, but I always had I would say expert help when it came to putting the tax structure together.
Absolutely. That's why I encourage everyone to build a capital gains tax exit plan, and to build a dream team for not only the building of your company and the modeling and the projections and the cash flows and everything else there, and properly pricing your company based upon a key financial models, but also when you go to exit. And that's why we wrote the book called Building a Capital Gains Tax Exit Plan. It's all about exiting multi-million-dollar assets, deferring the capital gains tax, and eliminating the estate tax, because it's painful if you work so hard to build that company for 5, 10, 15, 20 years just to have a lot of it wiped out with tax. You want to make sure you have a plan in place. Go to capitalgainstaxsolutions.com or check out the book on Amazon, Building a Capital Gains Tax Exit Plan.